Welcome, everybody, to the Chinchilla Pickin' Podcast. It is January 22nd, 2023 at 1:11 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am joined today by the one and only Brandon, Never Buy Bonds, Beaver.
That's changed.
That has changed, I know, but I
I
like to remember the good old days.
I still see more long term though. I still see more long term opportunity in the stock market right now, for sure.
Oh yeah, right now with the stocks being beat up the way they are, of course they
Yeah.
are, man. There's a lot of good value companies you could buy cheap for long-term investments right now if you were smart with your money and if you saw an opportunity, if you were able to get like an extra 20, 30, 50 bucks, 100 bucks, or maybe if you're, more highly affluential and you have like 10,000, 20,000, put it in right now, put a long-term investment in and start growing, man. There's never a bad time to start, and there's never a low enough number to start with, because if all you have in your whole entire life is $1 every single week, that is going to turn out to be more money than, that's more than what you had last week. And it's going to eventually grow. That's more than what you had last week. And that's the point I want to get across.
There's an interesting trend right now in the investment community, and that even though stocks are getting beaten up, companies like Morgan Stanley, for example, and I'll talk a little bit more about them when we get to my segment, but they're seeing actually a increase in revenue from their investment management divisions. And I think that's a lot to do with people who are more well off, who were individual investors last year and the year prior, got absolutely beat up by the stock market, and now they're looking, towards professionals to handle their money for them. And Morgan Stanley's investment management division's record revenue last year, and so they're benefiting from that greatly. We'll see how far that goes, because investment managers tend to underperform the S&P 500 historically, but 10 to 11% growth in your account, if people are promising you that, that's much better than what the S&P did last year. So,
if someone actually listened to our show, I bet you they could easily beat 10 to 11% in a year. I know I easily beat that last year that wasn't even a quarter of my return of what I invested for trades. I separate trades from investments. I separate the two. So for my trades, that wasn't even a quarter of what my return was. Now when you include investment, it lowers it a little bit, but you can easily beat that. That's not hard to do.
So last year, the 12 months last year, I'll be honest with you, I was up 5%. That was it. But the S&P being down like 20%, I took it as a win. Now, my Santa rally came late this year because I have had an incredible rally for the last 22 days. And my portfolio is low volatility. But last 22 days, it's put me up 15% for the last 12 months. So yeah,
nice.
It's been a good rally for me. I'm a little suspect that stocks should have, rocketed. I think that people kind of jumped in at the beginning of this year and then thought, well, last year was a really bad year. Let's take advantage of some opportunity. But we may have overdone it, but we'll see.
We have overdone it, and it is going to come back down. And there is still more bad news, because we need unemployment to go higher, and we need the economy to slow down more. So interest rates are going to go higher. So we are going to see more downside risk in the short term. But I think by the end of the year, we should be easily on the track by then to back to the way it should be. It's going to take years to get back pre-inflationary times, but we'll get there. Anyways, let's start the show, guys. Rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. You hear the live discussion here on the show for you. So we have some interesting topics today. We have some good things to really delve into. But Brandon, I know you got the meat of it, and you got it with earnings. So I'm going to let you take it away.
Yes. So we'll talk about the earnings of the companies that I was mentioning last week and the stuff that I was looking for with these companies. Now, Morgan Stanley's fourth quarter profits fell from a year ago altogether. but and this was hurt by a decline in deal making activity, which, I mean, that makes sense. The stock market being down 20-25%, NASDAQ and the S&P 500 got beat up really bad. Nobody wanted to IPO last year. Nobody wants to IPO right now. Nobody really wants to, do any mergers or acquisitions. So there's a few that are still going on, but it's definitely down. One thing here that really caught my eye out of this earnings. This last quarter, the bank set aside $85 million for potential credit losses this year. Now, let's compare it with a year ago. A year ago, they had only $5 million set aside. Huge increase. And just to be prepared, just to be prepared for a potential recession this year. So it kind of tells you what Morgan Stanley is thinking about for the next 12 months. Go ahead, Dave.
Do they have to do that because of the rules put in place after 2008 recession?
Well, no, that's why
I think some of that's required, isn't it?
Well, I mean, some of it is, but that's why I was comparing it to a year ago. Some of this has got to be intuition of what they think is going to happen in the next 12 months.
Yeah, well, I mean, yeah, and if they're looking at the same indicators we are, such as via the Apple Visa card, credit card, whatever you want to call it, the Apple credit card, you have an indication there that there's going to be a lot of defaults in the system. People overextended on car loans, yada, yada, yada. We go down the list, but everybody knows it. Go ahead. Sorry. I didn't mean to interrupt.
You're good. The bank's assets under management shrank to $1.3 trillion from $1.57 trillion last year. So percentage wise, that's pretty significant. Now, this is what I was talking about earlier. This is actually the company's wealth management business. They tend to have pretty steady returns. They posted a record net revenue of $6.63 billion, 6% higher than a year ago. And this is being helped obviously by net interest and higher interest rates, bank lending growth and stuff. Now, what caught me about this too, I think that looking at PNC, let's go to PNC because they talked about increase in lending growth. Now, PNC's loan division grew as well. They reported on Wednesday. They expect a moderate recession this year. 1% decline in real GDP is what PNC is saying. Net income of $1.5 billion. This was decreased by 6% year over year. Now, this included a higher provision for credit losses as well. They didn't say how much, but still a higher provision for credit losses from PNC, sort of following that line. Revenue came in at $5.8 billion. This increased $214 million or 4%. This was a result of higher net interest income. Net interest income of $3.7 billion increased $209 million or 6%. This was driven by higher interest earning asset yields and balances because of the raising interest rates. Full year record revenue for PNC Bank. Deposits were down for 4% year over year. That may start, if that's a regional bank, industry wide kind of thing, that deposits are going down, that may be an indicator that inflation will come down as well. Total loans were up 11%.
Wow, that's a big number.
So
that's good though.
It tells me that people are running out of money because there's no other reason to take loans and for loans to go up 11% with interest rates increasing as much as they are. Now, but surprisingly here, and I don't really know what to make of this yet, but delinquencies were down 25% year over year.
Well, that's because people are still managing to find ways to earn more money. I know more people nowadays are picking up second jobs. More people are picking up third jobs, gig working. People are still managing to keep their household afloat. However, that's an interesting stat considering people's household debt has increased year over year significantly. And
so
we reported on this last year.
Deposits being down, loans being up, delinquencies being down. Those all three of those stats kind of seem to run against each other. And I feel like something's got to give. Something's got to change from that. If you're going to have deposits down and loans up, then delinquencies are going to have to climb at some point.
And I agree, delinquencies will have to go, or deposits will have to go up.
Yeah.
Something like you said, something has to change. And with the Fed raising interest rates, trying to slow the economy, I don't see deposits going up. So therefore, the only thing to be true here to make this equation true would be that delinquencies would have to go up.
Yeah. And it does reflect, I think, good management at PNC Bank, though. I think that's the only way you can make something like that happen. But Kinder Morgan, they reported as well. We talked about them last week, so we'll talk about them this week again. Kinder Morgan, we were looking really kind of about the energy future. It's primarily looking at natural gas here. Now, the Permian Highway project entered service in January in 2021. So far, seems to have pretty good results for them. I mentioned last week they move about 40% of natural gas volume. I do get a little concerned looking at Kinder Morgan's debt. I would not buy this company at this moment in time. But talking about the natural gas pipelines, in the December quarter of 2022, adjusted earnings before depreciation and amortization expenses that rose to $1,353,000,000 from $1,215,000,000 a year ago. Product pipelines earnings before depreciation and amortization was $252 million. This was a decline from $281 million a year ago. And this was lower volumes of gasoline and diesel fuel. Now they said something that like kind of piqued my interest. They said that almost every drop of diesel fuel winds up going to California because of tax breaks on the diesel segment.
That's very interesting for California to give diesel tax breaks. But back to this, what do you know the debt to asset ratio for Kinder Morgan? Because I'm curious because you're saying it's too high debt for you. I just Googled it just now, and it was a little over 1, which is usually in that good range, 1 to 1.5. Is that good range to percentage? I looked up what a percentage, and I don't know if this number is true because I just Googled it as you were talking, and it was like a 95%. And that seems a little off, so I have to research that a little bit more. But there, what do you know the debt to assets?
I do not know the debt to asset ratio on this right now, no, just off the top of my head. I was looking at their balance sheet. I don't remember the numbers, to be honest with you. I should have put them down, but the debt compared to revenue but
you said the EBITDA is positive. They have a positive EBITDA
for the quarter.
So that's for the quarter. I mean, so that's a good sign. That's a healthy sign, at least, that the company is not running at a loss before they even take out taxes and everything. Like they're actually running a smart company now. They just have to include all that.
And they had close to $800 million on hand.
So they got cash on hand.
Yeah. So gasoline transported volumes decreased 2% year over year in December, but jet fuel volumes, not surprisingly, jumped 9.8%.
I mean, I would expect the volume to go down because they would have to move more out instead of. Are they talking about holding or creating, pumping, flowing, moving? What type of volume are we looking at here?
So they're talking about moving because that's mostly what they
moving. Yeah. Okay. So moving that type of volume, yes, you would expect it to see up because of more jet traffic and airplane traffic. Yes. Okay. So that makes sense there. So, and you're saying you're not going to touch it right now at its current stock price. Is that what you're giving it?
Yeah. So far, honestly, none of these companies except for Netflix, which we'll talk about. I don't
really not even you talked about you wouldn't touch Morgan Stanley.
No,
because right now the banks look good. The banks look healthy. And I don't see, there's a couple of them that don't look as healthy. Goldman Sachs wasn't as healthy, but they took a stock hit because of that. And they became more in a value range, closer value to a value range to me. Bank of America, I like what Moynihan is going on TV and saying. I like where he's admitting where they're making mistakes. He's admitting to what they need to do. You say these banks are adding more money on hand to compensate for equity losses. Yep. And so I'm like, they're doing everything correct. Why wouldn't you buy them right now? Because they are doing everything correct. They are shoring up their finances. They are putting all this extra money aside to cover losses. I think they're actually a solid buy then, wouldn't you?
No. I don't think they're going to go bankrupt anytime soon. But if I'm looking at the growth potential of Morgan Stanley, both from a business standpoint and from where the equity price is right now versus Microsoft or Google, I'm for sure siding with Microsoft or Google.
All right, so yeah, when you're comparing them, see that's not apples to apples, that's apples to oranges. So when you're comparing them to in that regard, yes, of course, you're going to go with the tech because the tech names have been beaten up, they're beaten down, and they're in a value, definitely a value play right now, and it's definitely one to buy. Like I'm sorry, I'm going to go on record right now here and say Amazon's a buy right now. If you have extra cash, I would buy Amazon, put money in
100%.
Amazon and hold it. You know, but
100%.
I mean, I still think. But I still think that the financials are going to have a decent year. You're going to see a 5 to 10% growth in financial banks this year.
Decent year for financials. Once we get a market rebound and we get through all this mess that we're in, you're trading off a decent year in financials. If you decide to buy Morgan Stanley over going with something, healthy like a Amazon or a Microsoft or a Google, and you're trading off decent performance there versus what is potentially spectacular performances in these other companies that have gotten, their butts kicked.
Yeah, no, I agree with you. I agree with you on that point. Yes. All right. And you said where we're moving to next? You said Netflix or what?
Procter and Gamble.
Procter and P&G. Yeah. Okay, that's a local company here in town. What we got?
Currency headwinds. Currency headwinds, not surprisingly, affected sales by 6%. This is a forecast $1.2 billion after-tax impact for this current fiscal year. So, the rising value of the dollar and raising interest rates are really hurting this company at this moment in time. Still beating on earnings and stuff here, but they're still too overvalued, in my opinion. Now, the CEO said in the conference call, I would say the operating environment continues to be difficult, and we expect it to be difficult in the second half. While I think the U.S. is holding up very well, enterprise markets are holding up very well. Recovery in China will be hard to predict. He's talking about China and said it's going to be very choppy in China. We expect China to be difficult in the second half, just as difficult as it was in the first half. The European markets will continue to have to work through some very high inflation numbers. I think we've seen a little bit of help via warmer winter season, and that's helped energy prices. But Europe is not through the potential issues that they've had yet, and I kind of paraphrase a little bit there. But so they're still seeing some troubles out of Europe. They're seeing a choppy recovery in China, and looking at the United States, they say potential recession here, but none of anything changes the way they're running their business, which is fine because they've been doing very good business. It's just the stock price that I'm concerned with. It's not the actual underlying business of the equity.
Yeah, and I agree. I don't have really any comment on here, but P&G is a complicated stock. Like for most of the 20th century, it went up steadily over time. Then we hit the 21st century, and it just was flatlined. Yeah. For probably a decade of flatlining. And then we had some movement in the 2010s. And I wonder if we're back to flatline in the stock, or are we going to see the continued growth that we had in the 20th century?
Just looking at the history of the stock market in the 20th century, for much of the 20th century, what everybody was obsessed with was conglomerates. How big can you get? How much of the world can you control? And then once we get towards the end of the 20th century and the beginning of the 21st century, we start looking at these companies as being overstretched, and they're not really focusing on any one particular industry. They're trying to focus on everything, and that kind of hurt people. They overdid it on the conglomerate thing, but then P&G started to scale back, and so did General Electric recently, and start to focus on the things that made them good, and try to cut off the things that were holding them back. So I still think Procter and Gamble right now, they're the businesses that they're running them well. It's just that stock price. I don't understand a near 30 price to earnings ratio. for a company.
Yeah, I think you're right, and I agree, But since we're going on this history point here, let me add to it because I like this kind of discussion. It's a good discussion. People are gonna say, "Gone are the days of the East India Trading Company,"
Right?
And P&G was it. But what I think happened around 2000 was that companies like P&G did not adapt well to the internet, and that's where you saw the rise of companies like Amazon, who are going to be able to do everything and anything and go anywhere and do anything and have all this kind of funds and expand in a more versatile, adaptive way to the ever-changing environment that we're in right now. And that's where you saw the rise of Amazon and Facebook and Tesla and Google come out of that 2000 and really take the place of the P&Gs and the other companies that were leading the way before that.
Yeah, one of these days I'm going to do a whole bonus episode on the things we mispronounce.
Oh, wow, that's going to be a big one. That's going to be a huge one. Yeah.
All right.
Yeah.
Now,
what you got?
On to Netflix, profit margin decreased from 17% fiscal year 2021. It was down to 14%. I think this was primarily because of currency headwinds. They kept saying that they think that currency headwinds will become neutralized pretty soon, but that affected them about 3%. They expect the ad tiered membership to be on pace with premium plans. I lost my notes here. Hold on, I have to edit that out.
Well, hey, here before you get going, before you find your notes, find out where you're heading at here. I want to talk about the currency headwinds because this is probably the third time you've mentioned this in a earnings call. And I want a side note on this because now this is affecting everybody. So let's take 5 minutes and talk about these currency headwinds. And the problem is the growth and strength of the US dollar, correct?
Mm-hmm. Yes.
That is growing so strong. This is why you're going to see ads all over TV late at night directed towards people to buy gold and silver. Here, the U.S. currency is moving this. You needed this is the year of the gold and silver, right? It's the Chinese year of the rabbit. It's not the Chinese year of the gold and silver. One of the things I'm watching to see that if will really affect the strength of the U.S. dollar is whether or not OPEC moves away from trading oil on the U.S. dollar. Saudi Arabia has already come out and said they are open to trading oil, not on the United States dollar. So this is a big move away from the strength of the dollar. Where are they going to go? Are they going to go to the Chinese yuan? Are they going to go Japanese yen? What is the move and how are they going to make it? And is it time to start consolidating the global currencies? Yes or no? That's a whole nother discussion there. But I'm looking to see if OPEC makes a move away from the U.S. dollar because the U.S. dollar strength will then drop. And I don't mean a lot. I don't mean a little. I mean a lot.
A lot.
That will have a big impact and a big movement. So these currency headwinds may not be a big issue 6 months from now at all, or even near. That might actually turn into a tailwind here very shortly.
It depends on how bad it is. I mean, if it becomes bad enough to where, the dollar starts to to inflate again, as far as, and by that, I mean inflation, which is the decreasing value of the U.S. dollar. I spoke weirdly there. So, but it depends on how, these things can be a headwind or tailwind. It just depends on how extreme it is. And let's talk about like the interconnectivity between that and what might happen to Bitcoin if that happens.
Yeah,
I would expect the value of Bitcoin to go up if, and probably by a lot, if OPEC separates itself from the U.S. dollar.
Maybe OPEC starts selling oil on using Bitcoin.
Maybe
that would really affect every market, dude. Currencies would just go haywire at that point.
Oil would go haywire. Ugh, I don't want to think about that.
Your brain's already like working out all the math, and it's just driving you crazy, isn't it?
I think it would be a bad idea just with how volatile crypto is, but I do, I mean, people will start, and then gold, the price will go up of gold, of course. There's people that do those infomercials, and that weekly infomercial called the Peter Schiff Show. That's essentially a gold infomercial, but he would be very very profitable if that was to happen.
Nice. Back to Netflix. Sorry.
All right, so
Side discussion.
profit margin decreasing from 17% in FY 2021 to 14% in FY 2022, partially because of the currency headwinds. Now, one thing, and I think that this is what made the stock price go up. They said they expect the ad tiered membership to, at minimum, be on pace with the premium plans without cannibalizing premium subscriber numbers.
All the premium plan holders are happy to hear that.
That's huge growth. Now, in the conference call, something that Reed Hastings said, he was talking about the potential growth for streaming, and he was saying that he thinks that people are essentially underestimating the potential growth of streaming. He said that if you look at across the world, there's no single country currently right now that on average its members spend more than 40% of their television watching time on streaming. That really surprised me because in my household, it's like 100% streaming. In many households that I know, it's 100% streaming. But he said that he's looking at some of these countries. Some of the countries have less than 5% streaming.
That is very interesting considering how available and how quickly it can move into an area. All you need is really an internet and Wi-Fi capability and then a device of some sort, and you can stream.
As opposed to the cable industry where some area, most of the areas you only have one option.
Yeah. Yeah, that is very interesting. It's a unique factor. I mean, that shows the growth of global growth, but I mean, I would want to know about the US numbers and the European numbers on that because I know their shows. I have a family member who has Netflix. I don't personally subscribe to them, but I've gone on Netflix and they are putting out more European shows, and I wonder if they're trying to hit the growth there, that in the Asian market as well.
I think so. It's just and the impact that they have on at least US culture here has just been phenomenal. I mean, everybody, the water cooler subjects are oftentimes Netflix shows now. I mean, Wednesday,
Witcher,
the Jeffrey Dahmer thing, the Tiger King. I mean, there's so much cultural impact that Netflix has had on us. They're like the Coca-Cola of streaming.
The Coca-Cola. Wow. Are you going to be like Warren Buffett and own Coca-Cola, though? Because that's what our listeners want to know. Are you saying buy Netflix?
And you know what? I've been saying buy Netflix for a very long time. It's doubled in price since the last quarter, and I still say you can buy it. I wish I would have bought it in June. I was screaming on this program to buy it in June.
But you didn't, did you?
I did not.
Do you own it right now? Do you own it right now?
I do not own it right now.
So why don't you believe in yourself enough to own it?
I did not think that with the amount of tech that I had in my portfolio, I had room for Netflix, but I do now.
You know, and here's the thing: I'm tech heavy as well. You're tech heavy. I think most people are tech heavy right now because things that we classify as tech, it's literally just part of our lives. Is it really tech anymore? I mean, it's just part of our lives.
Yeah.
Everything we do, it's all part of our lives. You don't classify CBS as tech, but yet you classify Netflix as tech. But they're the same thing. They're providing program and streaming services. They're media.
And everything.
Netflix should be media.
It is. Yeah. It's media and it's tech. And it's
entertainment. And Google should be publishing because Google sells ads. Right?
Yeah.
I mean, if we're going to classify these correctly, they're not all tech.
They've done a really good job of diversifying what they do into services in the stock market that would normally be considered consumer staples.
Okay.
Yeah. Tuesday, the company that helped Netflix set up their ad tier program, Microsoft, they report. I'm looking forward to that earnings call. I love Microsoft. I love Satya Nadella. I'm pretty sure I'm pronouncing his name correctly. But I like that guy. I think that Microsoft with Bill Gates, they were looking at the really looking at growth and then after Microsoft, it came it came down to let's look at the bottom line, let's grow that. And now Satya Nadella comes in and he says, okay, let's look at the company culture. And I think that they've really become the perfect company. So Tuesday, they'll report. I'm very interested in Microsoft's earnings. Wednesday, Tesla will report. And
I need I need a good report on Wednesday.
Dave, I think you
Uh,
should be looking forward. Excuse me, I've got a sore throat right now, so I apologize. But Dave, you should be looking forward to this. I think people are greatly underestimating Tesla. I think a lot of Tesla's stock market downturn has been political. I think that's a big mistake, and I think the thing that overrides any political ideology is green. It's money. So if they beat on earnings, and I think they will because I think estimates are way too low. I think you're going to have a good day that day on Wednesday.
I would love to have a good day that day, and I would love to be able to exit my position in a profit. I would love to be able to take a profit finally and move on. But
Now, if I'm
man,
wrong, we'll come on the show next week. I'll admit that I was wrong, and we'll talk about why I was wrong. And let's not forget, Tesla is my white whale. I am historically wrong on Tesla, but I think the stars are lining up nicely for a good earnings report on Wednesday.
I agree with you, and I agree with everything you said about Tesla. Yes, yeah.
So, and then Thursday it's Visa and MasterCard, and I think you know why I want to watch those earnings and listen into the conference calls. I want to know what percentage of credit people are using for their daily and monthly purchases if they give those numbers, and I want to see if credit ratings for Americans are decreasing or increasing. There's a lot about the macro economy that the Visa and MasterCard earnings will tell us.
Nice. I'm looking forward to those earnings as well.
And those, I'm not buying those companies either. I know a lot of people say you should buy Visa or MasterCard, but I mean, look, they belong to a group of about like 50 or 60 different companies that each have representatives that go into voting on what those companies do, which is why a lot of their business hasn't changed for the past 50 years, because to try to get that many people to agree on any single thing is just it's so hard to do. Steady growth, yeah, possibly, but you're not going to see any. I don't think any major innovation coming, particularly from those companies. Any innovation that happens within Visa or MasterCard usually comes from a third party, like Apple, for example, and then Visa and MasterCard jump on it.
Yep. I agree. I'm not going to add to because I want to talk about one of my topics. So,
okay. We still got time. We're 30 minutes in.
All right, nice. Look at that. All right, so I got two things I want to mention. This first one's just going to take really quick, but I do want to mention it, guys. And this is something we probably should have seen. So, activist investors, right? So Bluebell Capital Partners recently announced that they made a big investment into Bayer. Bayer is a medical pharmaceutical company. Most everybody's familiar with Bayer aspirins and seeing that product on the store, but they make lots of other pharmaceuticals besides that, right? And so every time you see a big activist investor or investment company take a big share of a company, you always think that, okay, this is what are they going to do? What's their purpose here? And typically more than not, their purpose is to break up the company and make money off the sales of the different companies that break off of it, right? Well, this is true here, but for some reason, it just surprised the people at Bayer. I don't know why. I'm reading these articles today, and it's talking about Bayer's facing demands from activist investor Bluebell Capital Partners to break up with a sale to company's consumer health unit, and at a later stage for a separation of Bayer's pharmaceutical and agricultural businesses. Now, first of all, I did not know that Bayer had an agricultural business alongside its pharmaceutical business, and to me, that seems counter. I mean, you're like feeding people with damaged goods so that you can sell the medicine for it. I don't know. Maybe that's looking too far into it, but anyways, nonetheless, they have an agricultural business and they have pharmaceutical business, and then they have the consumer health. That's the aspirin you see on the shelves. Those would be the three businesses that they take and break up. Now, we saw this with GE. If Bluebell Capital Partners can make this happen, this would be a good time to buy Bayer. If Bluebell can't, then it's not a good time to buy Bayer because they're going to go, they'll pull out and sell their shares and move on. So Do you buy at times like this? My answer simply said is no. You wait for more information. And if you're not going to buy the company before all this news, then I wouldn't buy it now based off the news. It doesn't change how you would buy or sell it. Right now, it doesn't. Because you don't know if they're going to be able to pull this off or if they can't pull it off. And that would be some advice I would give to someone. Brandon, what do you think?
Yeah, I agree with you on this one in particular. You're not buying on hard numbers, you're buying on speculation. Now, one other company that's facing activist intervention is Disney, and I actually would buy them because I like Bob Iger, and I like the fact that he recently retook the role of CEO there. And I'm kind of on the fence on whether or not I want Nelson Peltz to have a board membership seat there. And he's been pushing for the spinoff of ESPN and company to spin off, so Disney to spin off other portions of its company as well. And I'm kind of on the fence on that, but that is one that I would think about buying. But Bayer, no, I wouldn't touch it right now.
Yeah, exactly. And that's the point where I was alluding to. I like I said, that one was a quick 2-minute story. The next one has more bigger implications on natural gas and oil. This is a bigger story, guys. So this is something we've all should have known about if we are following natural gas and oil stories for years. This is something you do in your spare time, like me, then you would know about this. But if this is not something you do in your spare time, then you have no idea that this was even happening.
We are really fun at parties.
Right? Yeah. We make the conversation very light. Yeah. Hey, guess what's going on in the oil community here in the world? Anyways, the Netherlands always had this plan to close the Groningen gas field, and it was by October of this year. The reason behind the closure, they are worried about more earthquakes happening due to operating this natural gas field. So why would this be a big issue, right? Why? Okay, it's causing earthquakes. So let's just go ahead and close this. Well, they're closing this, but this is one of Europe's largest gas fields. So that's one of the biggest problem. The reason why that's a huge problem is right now Europe used to get most of its natural gas from Russia, and now they're not getting it from Russia because of all the quote unquote unproven sabotage that happened on the Nord Stream pipeline. And so now, Europe's really dependent on whatever natural gas they can get. Inflation has hit the UK and Germany extremely hard and hurt those companies because when your natural gas bill it goes up by extreme amounts and you can't really pay it, it becomes a problem. So the Dutch have come under pressure to change course on this because of the Russia invasion. But the government is keeping the line and saying, no, they can't resume it. They can only resume it as a very last resort. And that's if gas supplies run out. So they're basically what they're going to do is they're going to put a cap on it, but they're going to put a cap that they could take off if needed. So if they run out of natural gas, then they will take that cap back off and repump again. So they're going to keep everything in place and keep it, I guess the piping and everything maintained. So bare skeleton crew just to maintain it, just in case, because of what happened with the Nord Stream pipeline, that Europe runs out of natural gas, then they'll pump this back out again. It's a very strange situation. I never thought that that would be in this situation where they have to do and take these extreme measures, but here we are. And once they turn it off in October, if the Nord Stream pipeline is not pumping again, that's going to be a huge hit to natural gas prices, and that's something to keep in mind come October of this year.
Great.
Thoughts, Brandon? Anything?
I'm just I'm so confused as to what the thought process behind that entire situation is. But
well, I mean, I understand. Look, you got to understand. You can't have earthquakes happening all the time because of what you're doing. I get that.
Yeah.
I mean, we all get that. Everybody gets that. We got to shut this down. But when they made that decision, Russia had not invaded Ukraine and Nord Stream pipeline was not shut off. And thus now they're in the situation they're in now to where they're they have to come up with a backup plan in case the Dutch have no natural gas.
Unbelievable.
It's crazy to think that countries, first world countries, will actually have no natural gas whatsoever. That's a possibility of what might happen in the near future.
Yeah, Kinder Morgan actually reported that they've had a pretty good increase in coal.
We've had to, because again, this all goes back to what happened with the geopolitical events in Russia and Ukraine, and with the Nord Stream pipeline and everything else that happened with that. And this is, I don't want to get into politics of all that mess. I just want to talk about, like, that happened, okay, but this is how it's affecting the markets. This is how it's affecting everyday people, because now if you have a product, right, that everybody, they've built the backbone of their system based off the availability of natural gas, because you built ovens and stoves assuming that you're always going to have natural gas. And that's the system you have in place. And then all of a sudden you get to a point where, like, oh, we have zero natural gas. If you have natural gas, that is now tulip mania, and that is worth a ton of money. Hate to use that pun on the Dutch there, but that is now worth a ton of money if you don't have it. And that, you have to question some things about this. Like, are they playing that game? Hey, there's no natural gas in Europe. We'll sell ours, but at 20 times the cost.
Could this be a reason for the whole gas oven controversy here in the United States? Could this be part of the reason why, to try to cut back on natural gas? Could it be part of the reason why they're trying to take away gas ovens?
I don't know. I mean, I don't have a gas oven, so I don't know if that's part of the reason why.
I mean, a lot of people prefer to cook on them. I mean, I
if
like
you're a chef,
it better, but yeah.
If you're a chef or someone who cooks a lot, then yeah, you prefer to cook on it. It's better heat. It's more even heat. You can control the heat. But for us average everyday cooks, like, we're just like, I don't know, electric works fine for me. So I mean, yeah, I get it. I don't know. I don't know the push behind that, or the reasoning for the push, if you will. But I do know, like, here's how it's going to affect everyday people, and here's how it could affect natural gas prices. And here's if natural gas prices go up, then everywhere, then the oil companies and natural gas companies like Kinder Morgan would actually be a good buy, because now they could sell their products here in the United States that didn't cost more to create, that we don't have a shortage of, and they could sell it at a much higher price because that's what the market demands.
Yeah, but they're moving a lot of it too. So they all, they manufacture the pipelines and stuff like that. So they're going to take a hit on that kind of, on that business, as far as, like, if less natural gas is moving throughout their systems, and they're not going to get paid as much in that industry. But your other oil companies, pure, drill plays and stuff like that, I think would be better.
So you're talking like Rig or Apache?
Yeah.
Okay. Or Schlumberger. I just love saying their name.
Yeah,
Schlumberger.
me too.
It's a fun name. It really is.
It's a fun name. And I think
man.
it right.
Brandon, final thoughts.
I kind of already, my brain's empty now. Dave, you just broke it with that entire story. My brain's broken. Because the entire time you're talking, I'm thinking, like, okay, what's going to happen with this asset if they run out of natural gas? Like, where do we go from there? And then just the whole situation of that whole situation just it broke my brain.
It is crazy to think about, and that's a real possibility that might happen here in about a year's time. That actually might happen. So I mean, it's something to think about where you put your money, guys. So final thoughts up to me, guys. I'm hoping for Tesla for a good, personally, I'm biased on this. I'm really hoping for a good number from Tesla this week. I'll be watching those numbers. I will keep an eye on the oil and natural gas, as always, guys, and I'll keep you informed of where those are going. That's something I watch constantly. But I hope you listen to our show, listen to these earnings reports, how we really delve into them, and how Brandon analyzes these to determine whether or not he would buy or not buy. That's a good thing to do. Even though he doesn't take his own advice and buy Netflix, and he should, because it's a good company. Yeah, I don't have anything else. So having said that, we hope we've been entertaining.
Wait. I do have a final thought. Who Day and go Cowboys.
Oh my goodness. All right. There you go. I'm not going to say it. No. So as always, we hope in entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Have a good night.